Most people want to build a financial cushion for the future. We want money for retirement. We want security. We want freedom. We want a small nest egg that can grow over time and protect us in the later years of life. And one of the most common ways to do that is by investing in the stock market. But here's the problem. Most people do not trust themselves to manage their own investments. They think the stock market is too complicated. They believe only experts understand it. So they hand their money to financial professionals and hope those professionals will make good decisions for them. Joel Greenblatt, the author of the little book that still beats the market, argues that this is often a mistake. Many financial experts charge high fees. Many stockbrokers are motivated by sales commissions. Many mutual funds deliver decent returns before fees, but disappointing returns after fees. And many professionals fail to beat the market consistently. Greenblatt's message is simple but powerful. Ordinary investors can do better if they learn a simple, disciplined method. The stock market may look confusing, but there are basic principles that can help investors find good companies at good prices. And if investors follow those principles patiently, they may beat the market average by a meaningful margin. Before we get to Greenblatt's famous magic formula, we first need to understand why relying blindly on financial professionals is not always the safest path. When we are children, we may believe that money can magically appear under the pillow after we lose a tooth. Later, of course, we learn that the tooth fairy is not real. But as adults, many people develop a different version of the same fantasy. They begin to believe that if they give their money to the right financial expert, that expert can magically grow their wealth. The stock market seems to offer this possibility. Money can become more money. Investments can rise in value. A small amount saved today can become a much larger amount in the future. But because most people only have a basic understanding of how the stock market works, they often look for professional help. The problem is that many financial professionals are not worth the fees they charge. One example is the stockbroker. Many people assume that stockbrokers are experts who will help them find the best investments. But stockbrokers are often paid by selling investment products. Their income may depend on getting clients to buy something, not necessarily on choosing the best possible investment for the client. This creates a conflict of interest. A broker does not always need to sell you the most profitable investment. They may simply need to sell you any investment product that generates a commission. Another common option is the mutual fund. A mutual fund pools money from many investors and uses that money to buy a group of investments. This sounds convenient, and many mutual funds can produce decent returns before fees. But the problem is cost. Mutual funds often charge management fees. And once those fees are subtracted, investors may be left with returns that are lower than the market average. So even if the fund performs reasonably well, the investor may not receive the full benefit. There is one professional investment option that Greenblatt views more positively, the index fund. An index fund, such as a fund tracking the S&P 500, does not try to beat the market. Instead, it tries to match the performance of the market's leading companies. At first, this may sound boring. Why would you choose a fund that only tries to match the market? But index funds have one major advantage: low fees. Because they do not require expensive active management, investors keep more of their returns. And because the market performs well on average over long periods, index funds can still produce healthy profits. So if you want someone else to manage your money, Greenblatt suggests that an index fund is often a sensible choice. But he also argues that there may be a better way. If you truly want to maximize your investment results, there is no substitute for learning how to invest for yourself. And to do that, you first need to understand something strange about the stock market. Prices move constantly, but not always rationally. If you looked at a successful company like Google or Disney, you might imagine that its stock price moves in a smooth upward line over time. After all, these are strong companies. They are famous. They make a lot of money. They have large customer bases and powerful brands. So the stock price should probably rise steadily, right? Not exactly. In reality, stock price charts are not smooth. They are jagged. They move up and down constantly, even when the long-term trend is positive. This happens to almost every stock, even the stock of successful companies. For example, on November 13, 2014, Google's stock price on the Nasdaq was $558.25. But over the previous 52 weeks, the The price had ranged from $510.67 to $615.04. On that same day, Disney's stock price was $89.90. But during the previous 52 weeks, it had ranged from $68.80 to $92. These are large swings. But why do stock prices move so much? The answer is that a company's share price does not always reflect its real value. Sometimes a stock is undervalued. Sometimes it is overvalued. Sometimes the market becomes too optimistic. Other times, it becomes too pessimistic. To explain this, Benjamin Graham, one of the greatest investment thinkers, created the famous idea of Mr. Market. Imagine the stock market as an emotionally unstable person named Mr. Market. Every day, Mr. Market comes to you and offers to buy or sell shares in a company. But Mr. Market is not calm and rational. His mood changes constantly. Some days, he is extremely optimistic. He believes the company is worth a lot, so he offers to sell shares only at a high price. Other days, he is depressed. He believes the company is not worth much, so he offers to sell shares at a much lower price. The important thing is that Mr. Market's mood is not always connected to the real value of the business. This creates opportunity. If Mr. Market is in a bad mood and offers you shares at a low price, you can buy them. Later, when he becomes more optimistic and the price rises, you may be able to sell the shares at a higher price. The key is not to let Mr. Market control your emotions. Instead, you must use his mood swings to your advantage. But to do that, you need a way to judge whether a stock is cheap or expensive. You need a method that helps you compare the market price with the real quality of the business. And that brings us to two important numbers: earnings yield and return on capital. The first is earnings yield. Earnings yield tells you how much the business earns compared with the price you are paying for it. In simple terms, it helps you answer this question: how much income does this company generate relative to its value? Greenblatt calculates earnings yield by comparing EBIT to enterprise value. EBIT means earnings before interest and taxes. Enterprise value, or EV, is the company's market value plus its net interest-bearing debt. This method has an advantage over the more commonly used P/E ratio, or price-to-earnings ratio, because EBIT divided by enterprise value is less affected by differences in debt and tax rates. To understand this more clearly, imagine buying an office building for $1 million. You pay $200,000 in equity and borrow $800,000 through a mortgage. Now imagine the building produces $100,000 in EBIT. If we compare the building's EBIT with the full purchase price, the earnings yield is 10%, because $100,000 divided by $1 million equals 10%. But now let's look at the equity return after interest. If the interest rate on the $800,000 mortgage is 6%, then the yearly interest expense is $48,000. So the building's pre-tax income after interest is $52,000, because $100,000 minus $48,000 equals $52,000. Since you invested $200,000 in equity, your earnings yield on the equity is 26%, because $52,000 divided by $200,000 equals 26%. This example shows why debt can change the return to the equity owner. But the building itself still costs $1 million and still produces $100,000 in EBIT. That is why Greenblatt prefers using EBIT compared with enterprise value when measuring earnings yield. It gives a cleaner view of what the business earns relative to its total value. However, earnings yield alone is not enough. A company may look cheap, but that does not automatically mean it is good. So Greenblatt adds a second measurement: return on capital, or ROC. Return on capital tells you how effectively a company turns invested money into profit. There are many things that influence a company's quality, such as brand strength, strategy, management, and competitive position. But return on capital is one of the simplest ways to estimate whether a business is actually good at producing profits from the money invested in it. ROC is calculated by dividing after-tax profit by the book value of invested capital. Invested capital includes the money put into the business by shareholders, bondholders, and others. To understand this, imagine opening a restaurant. You spend $300,000 to set it up. In the first year, the restaurant makes $100,000 in profit. Your return on capital is 33.33%, because $100,000 divided by $300,000 equals 33.33%. That is a strong result. Greenblatt says that anything above 25% suggests that a company is doing well. So the idea is simple. You want to buy shares in companies that are both good and cheap. A high return on capital tells you the company is good at turning investment into profit. A high earnings yield tells you the company is cheap compared with what it earns. If you buy companies with both qualities, you are systematically buying businesses that Mr. Market may be undervaluing. But now comes the important question. How do you combine these two numbers into one clear investment method? That is where the magic formula appears. The magic formula combines earnings yield and return on capital into a single ranking system. It begins with a large list of companies, usually around the 3,500 biggest companies available for trading on major U.S. stock exchanges such as the NYSE and NASDAQ. First, the formula ranks all companies by return on capital. The company with the highest return on capital receives the top ranking. The next best company receives the next ranking, and so on. Then, the formula ranks the same companies by earnings yield. Again, the company with the highest earnings yield receives the top ranking. Finally, the two rankings are combined. For example, imagine a company ranks number 1 for return on capital, but number 181 for earnings yield. Its combined score would be 182. The companies with the lowest combined scores have the best overall combination of high return on capital and high earnings yield. In other words, they are good businesses available at attractive prices. Those are the companies the formula tells you to buy. The power of the magic formula is that it removes a lot of emotional decision-making. Instead of guessing, following tips, or reacting to market noise, the investor follows a clear system. And according to Greenblatt, the formula worked extremely well over time. During the 17-year period from 1988 to 2004, a portfolio of around 30 stocks selected using the magic formula returned an average of about 30% per year. During the same period, the market average returned only around 12% per year. That is a huge difference. So at this point, the obvious question is, if the magic formula works so well, why does everyone not use it? The answer is one of the most important lessons in the book. The formula works over the long term, but it does not work all the time. And that makes it difficult for professional investors to follow. For about 5 months of every year, the overall market will beat a portfolio based on the magic formula. The same is true for about 25% of all full-year periods. Even during the very successful period from 1988 to 2004, when the magic formula portfolio produced average annual returns of around 30%, there were still times when it performed worse than the market for 2 or more consecutive years. This creates a major problem for professional investors. Professional money managers must keep clients satisfied. Their clients expect results every year. Sometimes they expect results every quarter. If the manager underperforms for too long, clients may become impatient and withdraw their money. Even if the manager says, "This strategy works in the long run," clients may not want to wait. A money manager who fails to show strong results for several years may get fired before the strategy has time to prove itself. This is why many professionals cannot use the magic formula properly. Their time horizon is too short. They are judged too frequently. They must appear successful all the time. Individual investors, however, have an advantage. You do not have to report to clients. You do not have to impress anyone every quarter. You do not have to abandon a strategy just because it underperforms for a short period. You can be patient. And patience is exactly what the magic formula requires. If you can stick with it during both good times and bad times, you may benefit from the formula's long-term strength. But patience alone is not enough. You also need to apply the formula intelligently and manage risk carefully. That means choosing the right kinds of companies, owning enough stocks, and using tax rules wisely. Greenblatt argues that the magic formula can work, but only if investors apply it properly. The first rule is to use the formula mainly with large companies, not very small ones. Small companies can be difficult to buy at reasonable prices. Because they have fewer shares available, even a small increase in demand can push their stock price up quickly. This makes it harder for individual investors to buy them at attractive prices. Large companies are easier to trade. Greenblatt suggests focusing on companies with a market value above $50 million. Market value is calculated by multiplying the number of shares by the stock price. The second rule is diversification. Investors should own at least 20 to 30 large company stocks at a time. This matters because owning too few stocks increases risk. If one company performs badly, it can damage the whole portfolio. If one industry suffers a negative event, the impact can be painful. For example, imagine owning several companies in the same industry, and then a major event like a tanker spill damages that industry. If your portfolio is not diversified, your losses could be severe. By owning stocks across different industries, you reduce the chance that one event will seriously harm your entire portfolio. Diversification helps smooth out the results and keeps you closer to the long-term performance of the magic formula. The third rule is tax efficiency. Greenblatt recommends holding each stock for roughly 1 year, but the exact timing of the sale should depend on whether the stock gained or lost value. In the United States, profits from stocks held for more than 1 year are usually taxed at a lower rate than short-term profits. So if a stock has increased in value, it may be better to sell it after the 1-year mark. This allows the investor to benefit from the lower long-term capital gains tax rate. But if a stock has lost value, it may be better to sell it before the 1-year mark. Selling the losing stock can reduce taxable income on paper and lower the taxes owed for the year. This approach uses tax laws intelligently. The goal is not only to choose good stocks, but also to keep more of the profit after taxes. So the practical strategy is clear. Use the magic formula to find good companies at low prices, own a diversified group of large company stocks, hold them for about 1 year, and sell winners or losers in a tax-efficient way. When all of these pieces come together, ordinary investors may have a real chance to beat the market. The key message of the little book that still beats the market is that ordinary investors do not need to depend completely on expensive financial professionals. Stockbrokers may be motivated by commissions. Mutual funds may charge high fees. Even professional managers often fail to beat the market consistently. Index funds can be a good choice because they are cheap and tend to match the market's long-term performance. But for investors who want to do better, Greenblatt offers a simple method: buy good companies at bargain prices. The magic formula helps investors do this by combining 2 key measurements. The first is earnings yield, which shows how much a company earns compared with its total value. The second is return on capital, which shows how effectively the company turns invested money into profit. A company with a high return on capital is usually a good business. A company with a high earnings yield is often available at a cheap price. By ranking companies using both measures, the magic formula identifies businesses that are both high quality and undervalued. But the formula requires patience. It does not beat the market every month. It does not beat the market every year. It can underperform for long periods, which is why many professional money managers cannot follow it. They are judged too often and may lose clients before the formula works. Individual investors have an advantage because they can think long-term. If they stay disciplined, buy a diversified group of large company stocks, and use tax laws intelligently, they may achieve above-average returns over time. In the end, Greenblatt's message is not that investing is effortless. It is that investing does not need to be mysterious. The stock market may behave like Mr. Market, emotional, unstable, and irrational. But if you follow a clear process, stay patient, and buy good companies when they are cheap, you can use Mr. Market's mood swings to your advantage. That is the simple idea behind the magic formula. And according to Greenblatt, it still beats the market.